Oh, hello everybody. So quickly I want to explain you a little bit more about Warren Buffett, how he thinks and decides, how he invests. And I said it before, here are good ways to go on finance, Yahoo Finance. It's pretty easy to understand, and so to understand him better, the genius Buffett is he doesn't care so much about a quick buck. He rather cares about long-term performance and compounding. So he rather has a stock that grows, let's say, 15% than one that doubles every year, but he has a huge risk. So he would probably, let's look at Facebook. I think he said he admires the Facebook story, he admires Mark Zuckerberg, and it's an amazing stock, and I was surprised by it too. So if you look at it, it is quite interesting. The performance is an engine. It's at $75 now. It went up quite nicely. It doubled since I think they went public. Warren Buffett, first of all, what I said before, he looks always at the cash flow statement and the earnings. That's one of the most important things for him. He wants that they produce cash, and Facebook pretty much produces cash. What you see here in the cash flow statements, you have three important things, three levels in the cash flow statement, and this one is the cash flow from operating activities. So Facebook, even though it's new economy and it's a pretty new company, it throws off $4.2 billion on a yearly basis. And you see here it goes up. It was profitable. The core business is profitable, $1.5 billion. The following year it was $1.6 billion, and now it's $4.2 billion. So Mark Zuckerberg, what is he doing with it? He invests a lot. And so what you see is he invested here $2.6 billion. He put it in the core business $1.3 billion, and he did some investments. And last year, maybe takeovers for $880 million. And he doesn't pay dividends. That's a thing what Warren Buffett needs. He wants dividends. That's the most important thing for him. That gives him stability. And that's why he trusts it more. And also a problem he wouldn't like with Facebook, they issue new stocks, so they dilute the number of stocks, outstanding stocks. Warren Buffett likes the opposite. He likes that when the stocks when you have less outstanding stocks, so he likes repurchase programs, so the number of stocks get lower. That's what he loves, because then his holding is getting more worth. When you look, for example, at the Washington Post, you see it they bought back over decades a lot of stocks. They reduced the number of outstanding stocks dramatically, and that's how he also benefited, because the piece of the cake he owns gets larger and larger over time. Okay, let's look at some holdings he owns. Warren Buffett bought, for example, Verizon, the phone company. It's the number one in the US. Probably a cell phone contract you have with Verizon is a high possibility, because it's the market leader. And he bought it because it pays a nice dividend yield. It's the market leader. Warren Buffett loves market leaders because he has less risks. You have here a low PE ratio, price earnings ratio, a multiple of 11 is very low. And you have also what he likes a lot. Again, he looks at the cash flows, and the cash flow you can also see in one thing. It is called EBITDA. It's earnings before interest, taxes, amortization, and depreciation. And here you see a multiple of 6. Technically, it means you take the enterprise value, that is this number here, it's $305 billion of Verizon, and you ask how many times is the EBITDA built in, and here it says 6 times, and that's a very low multiple. In 6 years, the company makes back its just in cash what you paid for in 6 years. So that's an amazing low number, and that is why Warren Buffett likes this Verizon stock. Besides that they are market leaders, that they are stable, and that besides that they are benefiting through the mobile internet, what is really booming. And that's for him a way to benefit from those Facebook things, social media and stuff, and YouTube, and this is for him a way to benefit. And he says it's less risky, the fundamentals are more stable, like a PE ratio of 12 or 10, it depends which year you take, is more interesting to him than having a Facebook stock, even so he admires it. But the valuation is for him, it's not a value investing. If he sees a PE ratio of almost 100, it scares him away, even so it's growing a lot. Warren Buffett rather takes a company that does not grow, but the valuation is fair and reasonable. Here, look at, even if you look forward, the PE ratio is still 37 at Facebook. So that's why he decides to invest in Verizon. And also, what I said before, it is not paying a dividend. What else did he? He bought Charter Communications. Warren Buffett invested in Charter Communications. Here you see also a low EBITDA multiple, what shows you that the cash flow multiple is extremely low. It's around, okay, here it's around 10. It is a little bit more than Verizon. What else did he buy? He has IBM. He invests in IBM for a while. Warren Buffett likes IBM. It is a very old company. I said that before. He gets a dividend yield. He gets stock buybacks. And what is the cash flow multiple at IBM? It is pretty low. That's the standard for Warren Buffett, 8.9 times. And he likes Exxon. Warren Buffett bought Exxon, I think a year ago. Again, market leader. Number one, he gets a dividend yield 2.7%, a reasonable PE ratio 13.5, and probably what I said before, a low cash flow multiple. The cash flow multiple here you see 7. That is a signal, gives you a signal. This is what Warren Buffett likes. Anything below 8, 7, around 6 is amazing to him. And when you look through almost all of his investments, you will always find a low enterprise value EBITDA multiple. You will always find huge cash flows. If you look into the cash flow statement, you will find stability. It is a nice history. You know, here look, cash flow 44 billions, 45 billions. Okay, it went a little bit down. It has maybe to do with higher costs of drilling and finding oil reserves. The technology got better, horizontal drilling and fracking, but it costs also more money to find resources. It's far away, it's in the deeper ocean, so they have to invest more. And here you see here capital expenditures, 33 billion. So they invest a lot, 2/3 or even more of the cash flow they reinvest in their business. But they don't forget to pay to the dividends to their shareholders, and they reduce the number of shares, of outstanding shares, because they buy back shares, and they do that for 3 years in a row. A lot of share buyback, a lot of dividends. And you see the dividends payment goes up from 9 to 10 billion to 11 billion dollars. So Rex Tillerson pays a lot in dividends, and he's doing quite a good job. And so if you can look here to the details, it was founded Exxon 1870, and these are the things Warren Buffett likes. More than 100 years old, stable, market leader, lots of cash, lots of dividends, lots of share buybacks. That's all for today. Bye.